Imagine standing on a tightrope, suspended high above the ground, where every step you take threatens to tilt you either toward collapse or stability. That is exactly where the Federal Reserve finds itself today. Chair Jerome Powell has made it clear, the Fed cannot ignore the threat of inflation making a comeback, even as the American labor market shows signs of slowing down. It's a delicate, almost impossible balancing act, one that will decide the course of the U.S. economy for years to come. And Powell's words this week revealed just how complex and tense this situation has become. Speaking at an economic event in Warwick, Rhode Island, Powell did not come across as a man eager to make aggressive moves. Instead, he struck a tone of caution, emphasizing that the Fed's current policy stance, what he described as modestly restrictive, is well placed to respond in either direction. To put it simply, Powell believes interest rates are in a good spot to deal with inflationary pressures or a weakening job market, whichever takes priority in the months ahead. But he also reminded everyone that the risks are real, and they are two-sided. On one hand, tariffs and supply shocks could raise prices. On the other, job growth appears to be losing steam, threatening the Fed's second mandate of maximum employment. Powell's remarks touched a particularly sensitive nerve when he said, "We will make sure that this one-time increase in prices does not become an ongoing inflation problem." This line is crucial, because it signals that the Fed might be hesitant to slash rates aggressively out of fear that doing so could stoke inflation again. Tariff-driven inflation, Powell argued, may end up being a one-off event, but the uncertainty remains high. Policymakers cannot gamble on wishful thinking. They must plan for the possibility that inflation lingers, even as employment weakens. Behind these words lies a fierce debate among Fed officials. Just a week ago, the central bank lowered interest rates for the first time since last December. Investors cheered, betting that at least 2 more cuts would come by the end of the year. Futures markets are pricing in 0.5 percentage point in further reductions, which would take borrowing costs to their lowest level since October 2022. Yet within the Fed itself, not everyone is convinced this is the right path. Some policymakers are sounding the alarm over employment trends, while others continue to insist that inflation risks are far from contained. Consider Vice Chair for Supervision Michelle Bowman, who spoke in Asheville, North Carolina, almost simultaneously with Powell's Rhode Island remarks. Bowman, a Trump appointee, did not mince words. She said that the labor market is showing worrying signs of fragility and that tariffs will have only a small and temporary effect on inflation. Her warning was stark. If conditions continue to deteriorate, the Fed may already be behind the curve in protecting jobs. She openly acknowledged that policy might need to adjust at a faster pace and to a larger degree going forward. This is the kind of rhetoric that suggests significant rate cuts could be on the table sooner rather than later. Fed Governor Stephen Miron went even further in his very first public speech as a monetary policymaker. Miron, also closely tied to Trump's economic circle, argued that current policy is far too restrictive and is placing material risks on the labor market. He introduced a controversial idea that the so-called neutral rate, the level of interest that neither stimulates nor slows down the economy, is much lower than most economists believe. In his view, the Fed's key interest rate should be about 2 full percentage points lower than where it is today. That translates into a call for 8 quarter-point cuts, or 4 larger half-point cuts. To put that in perspective, such deep and rapid reductions are usually reserved for periods of obvious economic crisis, like the 2008 financial meltdown or the pandemic shock in 2020. For Miron to float this idea so early in his tenure signals how divided the Fed is over what the next steps should be. Contrast that with Chicago Fed President Austin Goolsbee, who told CNBC that while he does see room for rates to come down eventually, the Fed must be careful not to move too quickly. He reminded viewers that inflation has been running above the Fed's 2% target for more than 4 years straight. Even though the latest data showed the Personal Consumption Expenditures Price Index rising only 0.2% in July, keeping the annual rate steady at 2.6%, Goolsbee pointed out that inflation remains stubborn. He described the current environment as a kind of stagflationary dust that needs to settle before aggressive moves are considered. His position was clear: caution first, cuts later. Then there's Atlanta Fed President Raphael Bostic, who is not a voting member of the policy committee this year, but still carries influence in shaping the broader debate. In an interview with the Wall Street Journal, Bostic stressed that the biggest threat remains inflation, not employment. He warned that surveys and contacts across industries suggest prices could continue to rise in the near term. "I worry about that," he admitted bluntly. For Bostic, cutting rates too soon risks undermining the Fed's credibility on price stability, the very cornerstone of its mission. The labor market data, meanwhile, paints a complicated picture. Job growth has slowed significantly in recent months, with the number of people seeking work now surpassing the number of available jobs. This is a dramatic reversal from the ultra-tight labor market seen just a year or two ago, when employers were scrambling to find workers. Yet unemployment at 4.3% remains relatively low by historical standards. It's neither crisis-level weakness nor roaring strength. Instead, it's an in-between zone that fuels both sides of the Fed debate. Hawks point to the still low unemployment rate as proof that the job market can withstand higher rates a bit longer. Doves highlight the trend, slowing momentum, downward revisions, and increased fragility, as evidence that the Fed must act quickly to prevent a more severe downturn. The political backdrop cannot be ignored. President Trump's tariffs are directly raising costs on certain goods, complicating the Fed's task. On one side, tariffs fuel inflationary pressures by making imports more expensive. On the other, they may dampen business activity, hiring, and investment, thus hurting employment. Powell summed it up perfectly when he said, "Two-sided risks mean that there is no risk-free path." The Fed is being squeezed by contradictory forces, and whatever choice it makes risks worsening the other side of the equation. For everyday Americans, these debates might sound abstract, but the consequences are tangible. Higher rates mean more expensive mortgages, car loans, and credit card debt. They can slow business investment and hiring. But lower rates, if implemented too aggressively, could reignite inflation, eroding purchasing power and raising the cost of living. The stakes could not be higher. It is not just about abstract numbers. It is about whether families can afford homes, whether small businesses can secure loans, whether retirees can keep up with living expenses. Powell and his colleagues are not simply talking to economists. They are making decisions that will ripple into every corner of the American economy. The uncertainty is palpable. Powell's cautious approach suggests he does not yet see an urgent crisis. He is signaling patience, a willingness to wait for more data before committing to large moves. But as Bowman and Miron's remarks illustrate, not everyone is willing to wait. Some fear that delay will only make things worse, forcing the Fed to act more drastically down the road. Others argue that moving too soon could unravel the progress made against inflation. It is a battle of perspectives, fought with data, forecasts, and judgment calls. As the Commerce Department prepares to release August PCE inflation data, markets will be watching with bated breath. Any sign that inflation is rising again could validate Powell's caution and bolster the hawkish camp. Any sign of cooling could strengthen the hand of those calling for deeper cuts to rescue jobs. The Fed's dual mandate of stable prices and maximum employment has never felt more like a tug-of-war. And so the Fed stands on that tightrope, one misstep away from either fueling another wave of inflation or allowing the labor market to slip further into weakness. Powell's message was clear. The path ahead is fraught with risks, and there is no safe or easy choice. Investors, businesses, and households alike must brace themselves for a period of uncertainty, where every data release and every Fed remark could shift expectations and reshape the economic landscape. This is not just policy. It is a high-stakes drama that will determine whether the United States economy navigates these turbulent waters or stumbles into deeper trouble.